It's the first time in your life the number has that many digits in it. Maybe the house finally sold after 31 years in it and the check cleared this morning. Maybe you rolled the 401k over the week you retired, and now it's all sitting in one place, in your name, in cash. You log in, or you look at the printed slip the teller hands you, and there it is, 6 figures, sitting in checking or savings or a money market, somewhere safe, somewhere you can see it. And you feel it, that quiet exhale you've been waiting decades for. Not rich exactly, just safe. You did the thing you were supposed to do. You didn't gamble it. You didn't lose it. You brought it home and you put it in the bank. Because that's what your father told you a responsible person does with money. The bank is where money goes to be safe. Everybody knows that. The teller smiles. Congratulates you maybe. Nobody at that counter says a single word about the ceiling. Because there's a ceiling. There's a specific number. And past that number, the money in your account stops being guaranteed the way you think it is. It's not a tax, it's not a penalty, it's not something you did wrong. It's a line drawn a long time ago that decides exactly how much of your own money is protected if the bank behind it ever fails. And almost nobody who works at that bank is going to draw that line for you. You crossed it, or you're about to, and no one mentioned it. So let's mention it. One honest note before we go further. I'm not a lawyer, I'm not a banker, and this isn't personal financial advice. It's just the stuff our generation was handed a savings passbook for and never an explanation. So take it as a reason to ask the right questions when it's your money on the line and check your own situation with someone who knows it. Here's the strange part. When you stop and look at it, we were the generation raised on one unshakable piece of money wisdom. Put it in the bank. Don't keep it under the mattress like your grandparents did. Don't chase it into some scheme. Don't let it sit around the house. The bank is safe. The bank is grown up. Opening your first savings account was practically a rite of passage. Somebody walked you in, you handed over your babysitting money or your paper route money, and they wrote a number in a little book. And that number was yours, and it was protected. And nobody in all those years ever mentioned that the protection had a limit. Think about that. You were taught carefully to trust the bank with your money. You were never once taught how much of it the bank actually stands behind. Those are two completely different lessons, and our generation got exactly one of them. So here's the question this whole thing turns on, and I want you to hold it in your head while we go. Of the money sitting in your accounts right now, this minute, how much of it is genuinely guaranteed to come back to you if the bank behind it goes under? Not probably. Not they'd sort it out. Guaranteed. Most people have never heard the number that answers that. It's not hidden, exactly. It's just quiet, and once you know it, you can't unknow it. You'll check your own accounts before the end of this video, I'd bet on it. So if you've got a balance sitting in one place right now and you've never thought about this, do me a favor and remember to come back and tell me in the comments whether you were over the line or under it. Now, you may have already heard a version of this floating around. Somebody forwards you an article, or it shows up in your feed, and it's framed as some new IRS rule. The IRS is coming for the money in your checking account. Don't keep too much in there or they'll flag it. And it makes you nervous, because anything with those 3 letters in it makes all of us a little nervous. Let me clear that up first because it matters. This has nothing to do with the IRS. Nothing. The IRS is the tax authority. They care about what you earn and what you owe. This is a different agency entirely doing a different job, and it isn't coming to take anything from you. If anything, it exists to protect you. The rule we're talking about comes from the FDIC, the Federal Deposit Insurance Corporation, and what they do is exactly what the name says. They insure the deposits in your bank. When a bank hangs that little sign in the window that says your money's insured, the FDIC is who's standing behind it. They're a banking regulator, completely separate from the tax side of the government. The specific rule that sets the limit was written into law in the Dodd-Frank Act back in 2010, the big financial reform law that came out of the 2008 crash. We'll come back to why that timing matters. But here's what I keep noticing about our generation, and I'll own that I do it too. We've been burned enough times that the second we hear the government has a rule about your money, we assume it's the IRS and we assume it's a trap. And sometimes it is. But sometimes the thing everyone's whispering about isn't a tax grab at all. It's a piece of protection nobody bothered to explain. And by mislabeling it, we end up scared of the exact thing that's on our side. So it's not the IRS, it's the FDIC. It's been on the books since 2010, and it's not a penalty. It's a promise with a very specific ceiling on it. And that ceiling is the number I've been dancing around, so let's finally put it on the table. Here it is, $250,000. That's the number. The FDIC insures the money in your bank up to $250,000. And I want to be precise about how they count it, because the fine print is the whole game here. It's $250,000 per depositor, per bank, per ownership category. Hold on to that phrase, ownership category, because in a few minutes, it's going to turn into the best news in this entire video. But start with the simple version. In one ordinary account, at one bank, in your name, the guarantee stops at $250,000. Everything under that line, the FDIC stands behind. Dollar for dollar. If the bank fails tomorrow, that money is made whole, fast and in full. Everything above that line in that single account is uninsured. It doesn't vanish, but it stops being guaranteed. It becomes a claim you file waiting in line behind everyone else while the bank gets unwound, and you might get most of it back eventually, or you might not. And eventually can mean years. Now here's the part that ought to stop you. That number, $250,000, has not moved since 2010, 15 years. Think about what a dollar bought in 2010 versus what it buys now. Think about what a house sold for then versus what yours would sell for today. The ceiling on your protection has sat perfectly still, while the value of everything underneath it has drifted up and up. And it's worth knowing where the number even came from, because the history tells you something. When the FDIC started back in 1934, the limit was $2,500. It climbed slowly across our whole lives, $5,000, then $10,000, then $15,000, up through the 70s, $100,000 by 1980, right about when a lot of us were kids watching our parents bank. And it sat at $100,000 for almost 30 years. Then 2008 hit, the whole system shook, and in the panic they bumped it to $250,000 and made that permanent in 2010. So, notice the pattern. The number doesn't go up because banking got safer. Every jump in that limit came right after something broke. The ceiling rises when the floor gives out, and it's been frozen now for 15 years, which tells you either they think nothing's going to break again, or they just haven't gotten around to it. I'll let you decide which of those you find comforting. If you're doing the quiet math on your own accounts while I say this, good. That's the whole point. And if this is already useful to you, go ahead and hit like so it gets shown to a few more people our age who were never handed this either. Then stay with me, because now we get to the part almost nobody at the bank explains. The part that can quietly stretch that $250,000 into $1 million or more without you moving your money anywhere. So here's what that phrase, per ownership category, actually does for you. Because when most people hear the limit is $250,000, they picture one hard cap on everything they've got at that bank. That's not how it works. And the difference is enormous. The FDIC doesn't just count you as a person. It counts the different ways you can own money, and each way gets its own separate $250,000 of coverage at the very same bank. No moving anything anywhere. Walk through it with me. The money in an account in just your name. That's the single category, insured to $250,000. Now, a joint account you share with your spouse. That's a different category. And here's the good part. It's $250,000 per owner. So the two of you, on one joint account, are covered up to $500,000 together. That single account alone gets $500,000 in protection. Keep going. A retirement account at the bank. An IRA sitting in CDs, say. That's its own category too, with its own separate $250,000, stacked right on top of the others. And then, there's the one that surprises people most. A payable on death account where you've named a beneficiary, a POD, sometimes written as in trust for. Each beneficiary you name adds another $250,000 of coverage on that account. Now added up at one single bank. Your individual account, $250,000. Your joint account with your spouse, $500,000. Your IRA, another $250,000. A pod account naming your two kids, another $500,000. You're standing at $1.25 million in fully insured money at one bank, and you never drove to a second branch or filled out a single extra form beyond naming the people you were going to leave it to anyway. That's the news the teller doesn't lead with. They'll happily let you park $400,000 in one account in your name, 250 of it protected, 150 of it quietly exposed, when a small change in how those dollars are titled could have covered every penny. And if that POD piece rang a bell, it should. It's the same beneficiary designation that keeps a bank account from getting frozen when someone passes, which we walked through in another video. One little decision, doing two completely different jobs. That's usually how the smartest money moves work. They're boring, they're paperwork, and they quietly protect you twice. So do this one for me. If you've got money at a bank right now and it's all sitting in a single account in one name, that's the exact situation this fixes. Tell me in the comments, did you know your joint account and your IRA at the same bank were counted separately? Because most people are genuinely surprised, and I'd like to know if you were. Now let me tell you why any of this started feeling real again, after 15 quiet years. Because until recently, most of us never thought about that ceiling at all. Bank failure was a thing from the black and white photos, the Depression, people lining up at locked doors. It didn't happen anymore. Then came 2023. In the space of a few weeks that spring, 3 American banks failed: Silicon Valley Bank, Signature Bank, First Republic, not tiny operations in Yamahabam. Together they held around $550 billion in assets, and a lot of the money inside them was over the line. Businesses, wealthy depositors, ordinary account holders who'd parked more than $250,000 in one place because it never occurred to them that in the bank and insured weren't the same sentence. Here's what happened next, and this is the part I really want you to hold on to. The government stepped in and covered those uninsured deposits anyway. Everybody got made whole, over the line or not. And most people watched that and drew exactly the wrong lesson from it. They thought, see, the system catches you. Even if you're over the limit, they'll cover it. It always works out. But read what actually happened. That was a special decision, made in an emergency one time because they were afraid of a wider panic. It was not the rule. The rule is still $250,000. What they did in 2023 was choose to reach above the line. And a choice made once, under pressure, is not a promise made to you in advance. Next time, the people in that room might decide differently, and you would have no standing to be surprised, because the printed guarantee always stopped at the same place it stops today. So the 2023 rescue didn't prove the ceiling doesn't matter. It proved the opposite. It showed us, in real time, exactly how much money sits above that line unprotected, and reminded us that whether it gets covered depends on a decision, not a guarantee. I don't say that to frighten you. Bank failures are genuinely rare, and here's the reassuring truth underneath all of this. Since the FDIC was created in 1934, no one has ever lost a single dollar of insured deposits. Not one. The system works, but it works up to the line. Your job isn't to panic about the bank, it's just to make sure the money you're counting on is sitting on the right side of that line. So the guarantee is yours by right, not by somebody's good mood in a crisis. So what do you actually do with this? And the good news is it's simple, it's free, and you can start tonight at your kitchen table. 3 moves, and you've likely already seen the first 2 coming. 1. Use the ownership categories. If you're over the line in a single account, retitle some of it. A joint account with your spouse, a POD naming your kids, an IRA that's already there. Same bank, same money suddenly covered. 2. If you've got more than the categories can hold, spread it across more than one FDIC insured bank, $250,000 at each, and the coverage simply resets at each new bank. Boring. And it works. The 3rd move is for larger sums, and I'll name the category without recommending any particular company, because that's your call and not mine. Some banks and financial firms run what's called a deposit sweep network. You put your money in one place, and behind the scenes, they automatically spread it across a web of partner banks, keeping every slice under the limit. So a single deposit can end up insured well into the millions without you tracking a dozen accounts yourself. It's a real, legitimate tool. Just read the terms and understand who's holding your money before you use one. And here's the step I'd do first, before any of that. The FDIC has a free tool on their website called EDIE. the electronic deposit insurance estimator. You type in your accounts exactly as they're titled, and it tells you, to the dollar, how much of your money is insured and how much is sitting over the line right now. No sign-up, no salesman, no cost. 15 minutes tonight and you'll know precisely where you stand, which is more than most people can say about the single biggest pile of cash they own. One thing this is not while we're here, none of this touches your investments. FDIC insurance is for deposits, checking, savings, money markets, CDs, the stocks, the bonds, the mutual funds, the annuities, even the ones you bought through the bank. Those were never FDIC insured to begin with. And that's a different conversation for a different day. Today's just about the cash. So go back to the beginning with me. That first day, the check that cleared, the 6 figures sitting in one place, that quiet exhale of finally, I'm safe. Nothing about that moment was wrong. You did do the responsible thing. You brought the money home, and you put it somewhere solid. The only piece missing was the line, the one nobody at the counter was ever going to draw for you. And now you can draw it yourself. You know it's $250,000. You know it's the FDIC, not the IRS. You know your accounts can hold far more than that once they're titled right. And you know the difference between money that's protected by law and money that's protected by somebody's good day. And here's what I keep coming back to about our generation. We were the kids who let ourselves in, who figured things out because no one was standing there to explain them. We grew up a little suspicious of the smiling institution, a little unwilling to just take the sign in the window at face value. People sometimes call that cynical. I've never thought it was. I think it's the exact instinct that makes you the kind of person who watches a video like this to the end and then actually goes and checks, while everyone else assumes it'll all work out. That instinct was never paranoia. It was preparation. It still is. So tonight, sometime before you sleep, pull up your accounts and find your own line. And then tell me down in the comments, one bank or spread out, over the line or under it. And did any of this surprise you? I read them. And I learn as much from how our generation actually banks as you might learn from me. If this was worth your time, subscribe and I'll keep pulling apart the stuff we were never handed. Quietly, one number at a time. Take care of yourself and go check.